Hey everyone, welcome to another Vyzer Weekly. We're going to dive right into it. The reason we're doing this call today with Leyla is pretty straightforward. We had a call last week with Hans, and we talked about red flags and pitch decks. One of those has to do with the GP, some of them have to do with the deal themselves. But this one is going to be dedicated entirely to the GP, to the manager, the sponsor, the operator, whatever word we want to call them. And we're going to dig into that. And we brought in Leyla here, I mean, I've been following her for a while on LinkedIn. I'm super impressed with everything she puts out there. I mean, it's so straight to the point, honest, punchy. I love it. So Leyla, like kudos to you on that great content that you've been pushing out there I feel like every day. I don't know if it is every day, but I feel like a lot. I'm really excited to get you on. I'm just going to give some housekeeping and then just hand it over to you. So, as usual, this is a call that we do in order to help us all be better investors. It's recorded, but this is not a webinar. The idea that we're all seeing everyone is because we want people to ask questions, get involved. If you need to hop off again, this is recorded. We're going to share it afterward anyway. Um, so please feel free. These conversations are most interesting when people ask questions, and there's no right or wrong answer around that. So, without further ado, Leyla, it's really great to have you on. Why don't you give a quick intro so people know who you are, and then we'll dive into it.
Good. Well, first of all, thank you for having me. My name is Leyla Kunimoto. I am an investor. I am a retail investor. I invest my own money. I don't raise capital. I have been investing in the public markets since I was 19 and private markets. I discovered private markets in 2020, so about 6 years ago. My gateway into the private markets was real estate, syndicated real estate deals. Um, and then from there, it very quickly went to private credit, private equity, some venture capital. I joined a lot of groups when I first started investing in private markets to learn about the space, and it's kind of gone from there. 2 years ago, from the get-go, I networked with a lot of investors, with a lot of fellow investors. I spent a lot of time. I spent almost 2 years on the phone with GPs, calling hundreds of GPs, kind of doing due diligence on deals. And a couple of years ago, I came to a realization that there wasn't a voice that was writing or speaking about this universe from my point of view. I am an investor. I am not affiliated. I don't stand to gain anything by, selling certain products. I was like, well, all of the information asymmetry in the space is so imbalanced. I wanted to do my part to kind of balance it out a little bit. So I started writing about this publicly. And from there, it's kind of grown like a forest fire. I write a newsletter. I publish things twice a week. I cover private markets in general, and it's that includes the universe of real estate, from real estate infrastructure to private credit. Private credit is on the news a lot right now, and that's kind of been my story. It's the newsletter is now being read by nearly 15,000 people, by people in the industry, by advisors who sell these products, and most importantly, the people who are near and dear to me, other my fellow investors. And my goal is to increase the transparency in the space and kind of share the lessons that I've learned over the years.
I love it. And it does feel that way when you share all the content. Very authentic stuff. I do want to dive into because it is very top of mind now the past couple of days. And Mike, I know we didn't talk about this in the prep call a couple of days ago, but obviously Cliffwater is more and more in the news. And that is more institutional level type of private credit. Can you walk us through what's happening there? Because I think it'll help us sort of maybe dive into the whole subject of what happened there with the managers themselves. Are there things we could have identified or people could have identified before? And how can we apply that to this more smaller, mid, low tier private equity, private credit operators that people are investing in now?
Yeah, so let me give you a quick background on Cliffwater. Cliffwater is an asset manager. The fund that's on the news right now, CCLFX, Cliffwater Corporate Lending Fund, is a large fund. A lot of people are in it. Its net assets are at 32 billion or so. And this fund, what's happening there, this fund is structured as an evergreen structure. So investors can buy shares of that fund and then redeem those shares quarterly. Up to 5% of the shares can be redeemed quarterly, and that's kind of how the fund is structured. It's what's called an interval fund. Well, what's happening now, that fund raised billions of dollars, right? It went from 0 to 32 billion in a span of 6 or 7 years. It was on a frenzy, a fundraising frenzy. They raised billions of dollars last year alone. So you have this massive influx of retail money into that fund, and suddenly that influx has stopped. Um, we all hear about, stories about the valuation of software loans on the books. The fund invests in direct loans to privately held companies. And last week, or a couple of days ago, the fund made an announcement that they had 14% of shares were submitted for redemption during the most recent redemption window. Their cap is 5%, right? So they will redeem, the fund has to redeem up to 5% to qualify as an interval fund. They can elect to redeem up to 7% if they choose to. And they got, so against that 7% hard cap, they got 14% redemption requests. And what's happening now is when that situation happens, they will prorate every investor who has submitted requests for redemption. So everybody who wanted out is now only getting 50% of their money out, whatever they requested. So if they had, $50,000 in it and requested to redeem $50,000, they're going to get 25 out, and then they have to, go into the next quarter and redeem some more. The story with that fund is part of the problem with evergreen funds in general is you have an illiquid asset inside a semi-liquid fund structure. So typically, like in a typical, let's take a real estate syndication, right? You give money to a sponsor, the sponsor buys a property, renovates it, or does whatever they do with it. 6 years, 7, 8, 9, 10 years down the road, they give you the money back. There's no expectation that you can take your money out anytime during the 10-year period, right? Or 7-year period. With semi-liquid funds, there is a feature where you can submit, your shares for redemption, and the fund manager itself will provide the liquidity for those shares. This is different from public markets. In public markets, Litan, if you wanted to buy shares of a BDC and I own shares, if I wanted to buy more, I can buy them from you. The fund manager has absolutely nothing to do. They have permanent capital. They don't have to provide that liquidity. It's done between investors. With these semi-liquid Frankenstein babies that have sprouted up, and the structure is fairly new. It's only been in existence. It's been in existence for a while, but we've seen a massive growth in the structure over the past 7 years. So with this, it's the fund manager who has to provide liquidity. And if they don't have the liquidity, if they can't find the money to buy shares from investors, they will have, they can gate the redemptions, or, they can sell assets, they can borrow money. There's a number of things they can do. So this is what we're seeing right now. And could
And
it have been foreseen?
just to clarify,
Yeah.
right? Because it's a multi-billion dollar fund, but this structure exists also with smaller private credit type funds with also have some sort of liquidity. We know Mike and I know a lot of people. I think Mike is also invested in one in a couple of these. It's a very similar structure, and it's across the board. So it can be smaller and it can be larger, but it acts the same way. What's making the Cliffwater fund just different at the moment, just because there's so many redemption requests? Is that the only difference, that it's like a bank run, or is there something else happening that sort of shed some bad light on the managers of Cliffwater around this situation?
Yeah, a good question. It's not just Cliffwater. It's a bank run. It's basically a bank run by retail investors on private credit funds in general. We have seen it in the public space. We've seen publicly traded BDCs, which are effectively the same thing. It's a debt fund, right? But they're just publicly traded. We've seen valuation not collapse, but valuation declines, right? Most publicly traded BDCs are now trading at a 20+% discount to net asset value. In these large funds, the net asset value is what you can redeem at. So there's a little bit of that. But yeah, this is a thing across the board that shows not just Cliffwater. We've seen the same thing with BCRED, with Blackstone's private credit fund. That one's $80 billion in AUM, if memory serves me. Same dynamic. There's just too many people are asking to take their money out because there are concerns about AI disrupting software. People are now starting to ask questions about those NAV, net asset value marks inside the funds. And as an investor, my decision tree is fairly simple. If I'm promised semi-liquidity, there's no penalty for me to take my money out, sit on it for 2-3 quarters, and then redeploy it, right? So I think there's that dynamic playing out too. On the smaller end of the market, we have the dynamics are all the same. So you can have a private credit fund that's a Regulation D fund. It will be much smaller. It doesn't have to file with the SEC other than the Regulation D form, but they do the same thing, right? They raise money from individual investors, lend it out, and then provide liquidity to investors. The fund manager provides liquidity to investors. So it's exactly the same thing. Maybe the assets are different inside the funds, but
Do you
the
think there's
structure's the
any
same.
inherent risk, though, to investors' equity in these types of funds if they're not even looking to redeem, but other people are running on it?
Yes
Because
and no.
the reason I'm asking because like we've historically talked about two ways where you lose money in the private space. Like either it's stolen from you because the GP is a fraud, or it's because they just managed the asset or the assets if it's a fund poorly and you lost your money. This doesn't seem like either of those two cases, right? Because it's just the asset class as a whole, because of market dynamics, is suffering. This has nothing to do with the GP, even though like that's the essence of this call. I just think it's an interesting conversation. Neither fraud or poorly management, just it sucks, but the market dynamics are changing. Is that sort of what we're understanding from this?
It's a macro. Yeah, it's the market. It's the latter. The market dynamics are changing. There's nothing wrong with there's nothing inherently wrong with private credit assets, with the assets, with the loans that those funds hold inside. Even if there is, it's not going to be a big fat zero, right? It's going to be, maybe there are some defaults and maybe the recovery is going to be low and maybe it's 10% write down.
But I could see where, as an investor, if the public markets are all, or the public BBCs are all at 10% or more of a discount, and your privately held ones are still at par, why would I not, if I want to be invested in that, why would I not want to redeem at par from one and then buy at a 20% discount in another? Because likely the par valuation is not correct, or the 20% discount is not correct. But either way, I would be better off as an investor being in one that was publicly traded at a 20% discount, is my thought on it. And so people are just making that logical decision to that if they want to stay in this space, to reallocate to the ones that already see the discount. And I think people are lightening up on this area because there's concerns that there's actually more risk than what they thought. And so it's a logical thing that way. They're just getting stuck because of the gating and the way it's set up.
You can
This is
tell, yeah,
precisely it, Mike.
yeah.
It's exactly it. That's the most obvious trade. If I can sell something at $1 and buy the same thing at 80 cents, why would
Right,
I
with a
not
different
do
name
that
on
all day
it, but
long?
essentially it's the same thing. And I know, Layla, you're one of those people that I think is really good at assessing big operators like that on how well they make their loans. Because like me as an investor, I'm going to look, if there's 10 people all doing private credit, I'm going to assume they're all institutional grade, public, private. I'm going to assume they're all the best. My guess is you're somebody that's gone deep enough though that you know that some people are better at it than others, and therefore you could choose the best ones in that market of who likely would have the least losses given that situation if there was a disruption.
So there's a convoluted answer to that. From my seat, if you're an investor in my seat, where you don't have any proprietary information, where you're what's given to you is simply what's in the SEC filings. It's virtually impossible to do it without crunching vast quantities of data. It's impossible to tell. There are some tells. For example, if it's the same loan to a company, let's take Medallia. Medallia was a large publicly traded company. It got bought out by Thoma Bravo, by a large private equity shop. And then a bunch of the who is who of private credit issued loans to do that buyout. So that one loan is showing up on a bunch of different books. Like KKR is in it, Apollo, Blackstone. They all mark that same loan differently, though. So you can look at that and say, okay, well, these guys are marking it at 97 cents on the dollar, for example, and these guys are marking it at 80, 85. So, obviously one is being more aggressive with the marks when the loan is the same. So that's one tell. Another tell is when the loans exit, when those assets are sold or repaid, are there booked losses or are there booked gains? So how close are we marking those loans to what actually happens, right? Because I can show you, like, unrealized gains can be anything. It's a number you can take out of basically thin air. And yes, there's a process, and yes, there's sometimes third-party providers who provide that valuation, but you can take that and make it anything. Realized gains and losses is the tell. Like if there are consistent realized losses, we can tell that whatever the valuations are on the books, they're not accurate or they're overstated. So that's not the tell. On the smaller side of the universe of GPs, you can tell a lot of the same things, but you need to go into the financials and look back at least 4 quarters. And you need to get, the only thing you need to do is just get the 3 financial statements, at least 4 quarters. I like to look back 8 and just see what happens in the fund, because I do that. I'm a numbers person. I'm a huge advocate of don't get on the phone with the GP. Just ask for the financials and figure out what the story is, because you can tell if the fund is generating realized gains. If it's a private credit fund, you can tell where the money is coming from. You can tell if they're generating enough cash flow to cover distributions, because that's not always, like, a fund could be generating 5% yield from the underlying assets and paying 7% to investors. So that's it's perfectly legal. You can do it all day long, right? As long as you have the cash coming in. So those are the questions that you can kind of take a look at, and all of that is in the financial statements. Now, if that passes, now you can move on to the next level of due diligence.
So the difference, basically, if we take an institutional fund manager versus a small private, or they can both be private, but a smaller fund manager, are those financials usually easier or more difficult to receive from the larger versus the smaller ones?
Larger ones will have much more detailed financials. They're often going to be audited by a good auditor, by one of the big 4 accounting firms. You will have,
Well, you
all
just
have
email the
heard of
GP and say, listen, please, I'm not gonna get on a call, just or the IR team, just send me your financials before we even get on a call. Like a Cliffwater would just do that, send you it over email?
better. Cliffwater, I don't have to get on the phone. I have to log into the SEC website and pull those financials myself. So they filed with the SEC. A lot of those funds will file, and it's super easy to get that. With smaller fund managers, you have to, get on the call or email the IR team and say, hey, can you send me? I've had people who run private debt funds not give me the cash flow statement, which is a tell too. Like that's a tell, right? If they refuse to do that, to me personally, that's the reddest of all red flags, and that's the end of due diligence. I don't need to get on the phone with somebody
Yeah.
beyond that.
Yeah, that's what Mike and I have spoken about that, multiple times around, give me your financials and make sure they're audited by a known auditor and not someone who that might be their only client. And then that's sort of a red flag, right?
Well, it
Um,
depends on the size, though, too. I mean, and I'd be curious, Lily, to hear what you think. But like, my thought is that at 50 million and above, you should have an outside auditor, and at 100 million, that's a no-go. If you're bigger than that and you don't have an auditor, there's no reason to invest with you. Like, you should absolutely have a good, solid, outside auditor at that level. But somebody who's got a $10 million fund that is making loans on fix and flips, that kind of thing, and aggregating it into a fund, they're not going to be audited. But hopefully you can look at their loan tape and see what they're doing, though. And you need to know the GP too.
Loan tape, I will caution though, Mike. Loan tape is one thing. It's kind of like seeing the top line revenue. You need to see the cash flow statement. You need to see what they do with the cash that's coming in
Hmm.
because there's a lot of things that loan tape
And
is
and
not
will the
going to tell
smaller
you.
ones give you that? Because that, to be honest, that's not anything I've ever looked for. I've just looked at, how the loans are doing, what loans they're making, new loans, what's being paid off, that kind of stuff, if anything's late. But yeah, I shouldn't say that under normal circumstances, I don't get into it. Like when I did a raise kind of thing, like where we were doing a fund of funds, absolutely. We got into all those details, including calling the auditor and, talking to their actual companies they owned and that kind of thing. But that's not my normal thing for just writing $100,000 check.
Leah, do you think there's because also Hans here wrote a comment about publics, privates. We were talking about more private, larger institutions versus private, smaller managers. But and then we talked about the publics in the sense that, well, if you can buy a similar asset class at a discount, then it makes more sense to buy it there. And then I think that's where Hans came in here talking about the fact that many times the problem with the public markets is that the share price doesn't always represent the underlying asset price, just the supply and demand for that share, right? And that and either an advantage or a disadvantage if it's above or below the market. And so I agree with that, but that doesn't mean that sometimes there are deals that you can get in the public markets that a price is for example, a REIT like you mentioned, if it's underpriced, then you can buy it and then make a profit when it goes back up. All right. So when you're looking at those institutional level GPs, and the questions that you ask versus the smaller ones, other than the financials, because we talked about this as well, I think a couple of days ago, which was, when you look at the larger ones, it's all a data play. When you look at the smaller ones, it's all a personal play. Where does that line, start and end in terms of small and large? Like, what do you think about that? How do you define? Well, this is someone I'm going to go deep just on the data, and this is one I'm going to go deep on the person of the GP that we're talking about.
Yeah. So with any size of GP, I think the most important thing when doing due diligence is the experience of doing similar deals, right? Whatever the asset class is. Um, and then, so regardless of the size, the first thing that matters to me personally is the experience, is the track record, the experience doing a certain asset class. How many times have they done it? Like, what do they bring to the table as far as, special sauce, for instance, if they're doing certain things or size. Sometimes the size itself is the advantage, right? They get a look at certain deals first before anybody else. They can take down certain deals. Same thing applies to the smaller end of the spectrum. There are GPs who can take down very small deals and make a lot of money. And because they're small enough, they can go after those deals. Like a publicly traded REIT might not go after a 20 unit property in outside of Portland, Oregon, right?
Probably not.
Um, so there's that. And when the track records, and I think we had this conversation before, when evaluating track records, the most important thing is how the money was made. It's not the amount of money that was made. It's how it was made. Was it made because cap rates compressed? Was it made because you raised a lot of money and just are paying out a distribution that is not reflecting the yield on your underlying portfolio? Was it made because multiples expanded, like in private equity, right? You buy a company at a 10 multiple and you sell it at a 14, boom, you made a lot of money. You didn't need to do anything operationally to improve that. So that's where, and that's, if I could wave a magic wand and make this, and make one thing change, I would have every GP disclose the detail, high enough level of detail where an investor can figure out whether, what were the contributing things that generated those outsized returns or whatever the returns are. By the same metric, every loss is not created equal. I have seen deals where the GP barely squeaked out. They increased NOI by 37% in a matter of 5 years or 3 years, but barely squeaked out and returned the capital and generated 1.0 DPI distribution, right? Multiple investor capital. So they just returned the money and the returns, are dismal. by every metric. But when you look underneath, they did incredible things to the property. They just got caught in the wrong cycle of the capital markets, for example, right? They had to sell because the loan was maturing, whatever the reason is. So it works both ways, and it's important for investors to understand how the money is made and which levers did the GP pull.
Yeah, I
Was it
think
luck or was it skill?
yeah, we talked about that last week with Hans as well about sort of like what's behind the numbers because a beautiful number doesn't mean as much as the details behind it, right? And I think that's a really important point to emphasize on and on. The track record, I think it's really important, but I think it's also tricky sometimes because I don't, and we talked about this as well, and I've spoken about this in the past. You know, if it's an emerging manager, it's a new GP coming to the market, has a very lean track record, or maybe like doesn't have a track record for syndicating deals or for raising funds. They might have other stuff they've done. That doesn't mean it's a bad opportunity. It might be an amazing opportunity, just it's a higher risk opportunity. And then you expect, because of the higher risk, to receive higher premiums. If it's lower fees, if it's better splits, if it's better returns, whatever it is. So it is important to just clarify. I think you need, I don't know, I assume you'd agree with this, but it's the track record is important, but it's not, it's all about risk mitigation at the end of the day, right? The more deals they've done, if you're going into GP who's been operating for 30 years, has, you know, 100 realized deals that they've gone full cycle on, and everything has been great operation, well, that's great. The risk is low, but then usually the premiums you're going to get paid are also equivalent to that. So, um, very experienced GP, you pay a high price. Low experienced GP, you get a better price. That's sort of like the way and Mike and I also have this debate, like he's going off to sophomores, I'm fine with freshmen as well. So it's like, what do you think about that?
And that's fine.
Do you invest with like emerging
Yeah,
managers as well?
I do not personally, but this bucket of capital that's invested in private markets serves a very certain. It's a small sliver of my overall capital, and it serves a very certain purpose. I look for very specific things with this particular bucket, but absolutely, there's no wrong answer here, right? But I will also say this: the less experienced the GP, the more detail they need to provide to investors when presenting a deal. They need to explain what they're doing, why they think it's going to be good, what the mitigants are, right? In I would expect that to be in a lot more detail than somebody who has a 27-year track record syndicating, I don't know, industrial properties in Wisconsin, right? uh, that kind of track record gives you the storied track record of doing the same thing over and over again gives you a pass to be very high level when you present. And obviously, if investors ask, you have to disclose. But for newer GPs, they don't have that luxury. They need to be very explicit about what they're doing and why they think they're going to succeed. Because sometimes I see pitch decks and they're like 5 pages long, and this is their third syndication, and the first two they've never exited, and the deck is light. There's no pro forma. I mean, like that should be a non-starter.
For sure. What else do you go into when you're doing due diligence around a private GP that doesn't have an established, well, maybe they have an established track record. Do you go on like the personal level of the GP in terms of like lawsuits, SEC, I don't know, actions that are going against them? Do you check that out?
Yeah, I do. I do a pretty detailed research on the principles, right? And I don't care how many wives they've had, nor do I care how many DUI tickets they have. But I do care about lawsuits. I do care about any kind of SEC violations. That's important. Once you know, this is the beauty of building community for all of those on the call. Once you know enough investors, you can reach out to the people you know and say, hey, I'm looking at X, Y, and Z. What do we have? And investors, LPs are, I call them my sewing circle, because you'll get a lot of kind of stuff through the grapevine that you might not get in a pitch deck. There's a lot of reputation matters a lot. And if you can find a way to check somebody's reputation, it's not an all and be all, but it's a good starting point.
Yeah, we talked about that just before we kicked the call off. And by the way, we're at 30 minutes after the hour, so if anyone has any questions, like please feel free to butt in, unmute yourself, or write in the chat. Don't be shy. Um,
I have a question. I mean, it's a little bit off topic, but I'd love to hear this. So within this whole private credit, there's a lot of
Wait,
talking
hold on,
about,
but
and
Mike, before we go off topic, I want let's stay
okay,
on topic for a sec because I do have
all
just
right.
one thing. So we talked about this just before we started recording, and this is about the herd mentality. Like a lot of us are in a bunch of these groups and communities, right? And one of the best things is to be in these communities, to be minded and aware to what's happening and share insights between people. The downside of it is that we have this herd mentality that we've seen over the past decade, where people have become like ultra lazy. I'll just say they're lazy and they just put their trust in someone else or other people, and they see, oh, everyone's going there. I don't have to do my DD. Seems like a good deal if 100 other people in my group are doing it. I'm going to go in as well. So let's talk for a second, Mike. I know you also have a lot to say about the herd mentality. Let's talk for a second just about the fact that we're in these groups and communities in order to gain more knowledge around GPs and to understand if we should or shouldn't invest with them. What are your thoughts around those groups?
I'm I'm a big fan of a lot of information. So if you the easiest way to do that is via groups because you get to meet a lot of investors and you get to meet GPs who are pitching deals nonstop to those groups, right? If you're a single solo kind of investor, it's really difficult to get your deal flow. And maybe not today. Like today, you have plenty of platforms where you can have deal flow nonstop, right? Whatever asset class. But with the benefit of the group, Litan, to your point, is being able to discuss those things. A lot of those groups have some sort of a forum component to them where you get to discuss those things. Um, you mentioned it in the conversation before. It's you want to be careful who you listen to because there's a lot of noise. You have to separate the signal from noise when you're inside those groups, and you have to be very, very aware of the herd mentality. I've seen it play out. You get swept up in it. You may not realize you were doing this, but there's a herd mentality. Everybody kind of comes to a consensus, and all of a sudden, everybody ends up investing in the same deal without asking the most obvious questions.
Right.
Can I ask a question kind of around this
Sure.
topic? What about having an sort of a setting guardrails for yourselves? I'm wondering what no more than 10% of your assets with one GP, your investable assets, no more than 5%, no more than 5% in one deal. Maybe you change those based on the experience of the GP. Seems like if you set some of the and then also on diversification, no, say private credit, maybe you say I'm okay putting a certain percentage in private credit, but no more than that, so that if that's gated, then I've got other places to go. So I just wonder what you guys all think about, because it seems like that's kind of important. I've focused on trying to develop that for myself to stop myself from the herd mentality, from the shiny penny, from all that kind of stuff. So I wonder what you think about that.
I mean, I'll hand it over to Lay in a second. Just the way I think about that is you have to have a goal. What are you trying to achieve overall with your net worth? Is there a number you're trying to achieve from a growth standpoint? And then you build a strategy in order to reach that number. And that strategy usually contains different mixes of your, asset classes. And then you go down from there. Personally, I'm not a big diversify. Like, I mean, I diversify with GPs, but over the past decade, I've sort of consolidated a bit of that just because I've found ones that are good that I trust in the different asset classes. But at the beginning, when I was getting started to deploy capital, I diversified like crazy because I didn't know which of them are the good bets. But that's just me. Layla, what do you think?
I think it's a great, yeah, I think diversification is important. I think, Mark, I think you bring up a great point. You need to know what you're after first, right? And you need to have guardrails, and it's super important to not exceed certain things. But I also think it's important to know, like to me, I know what I want from this 10% bucket. I know the cash flow I want. I know what I'm trying to do. I know what I'm trying to diversify away from, right? I know what this bucket does for me. And when I know that bucket so well, 90% of the deals that land on my desk, I look at everything now just because I have to write about it. But 90% of things that land on my desk, I can open, and within 2 minutes, I can tell you it's not a good fit. It streamlines the process tremendously. It streamlines, to me, certain GPs are no go. I don't care how good they are. There's a certain minimum level of threshold that I personally have, and there's nothing wrong with GPs that don't meet that threshold. It's just my personal needs. I know exactly what I'm after. And it's extremely helpful. I also look at it from the standpoint of, I think there was a lot of FOMO in years past, maybe a little bit less today. I am in the camp that I don't have to be deployed. Cash is an allocation. It's in my portfolio. Cash is a pretty sizable allocation right now, and that's okay. I don't look at it in the sense that, oh my gosh, what am I going to do? There's like so much cash piling up. I don't care. I there's a band, and I give myself a wide enough band where I say, okay, I'm okay with X% of my money being in cash, and that gives me the flexibility when something really good comes along, I can deploy into that.
I think what Mark's asking is though, like when I think about it, I have my immediate to 3 day money that I can get a hold of. I have my 90-day money, I have my annual money, and then I have the long-term stuff that's sort of like churning through. And I think maybe, Mark, what I think you're saying is like in that, let's say you have a 90-day bucket, should all of your 90-day money be in your top pick? Or like in this case, if you picked Cliffwater House, you stuck. Or if it was a year or two ago and it was Polaris, you'd be kind of stuck. And so, or do you split that up into a couple of different
Yeah, I guess to
options?
me, it's, from what I hear, private credit. I kind of wonder if, I guess, the people that got into that are trying to redeem now really didn't understand what they were getting into, because it's pretty clear if you'd looked at anything. I mean, the private credit deals I'm in, mostly surrounding real estate, all have the 5% gate. So I know that I mean, to me, that can't be my money that I need to access. And I just think for a lot of different investments, especially maybe on the real estate side, it makes sense to not over concentrate in any one thing, whatever that one thing is. That could be public stock market too, whatever it is, just to have at least some level of, and I guess you've, Latan, gone away from diversification. And I probably right now, I just retired. Or just went part-time, sold my company and went part-time. But I think I'm probably more diversified than I probably should be, but because I'm trying out different stuff, changing from a growth mindset to more of a cash flow mindset as I kind of move into retirement. But I've also looked at it as, if I make a wrong bet on any one of these things, I don't want that to really impact my lifestyle. And so that's part of it, is it's both knowing what I'm getting into and not expecting cash flow when cash flow is not what that thing will do. And I look at the, credit fund. Yeah, it's got some cash flow from what I get on a monthly basis, but it may not be cash flow from if I need to access the principal.
That's not
So
cash flow. That's liquidity, right? In a sense.
yeah,
But
exactly. Okay, it provides some level of cash flow, but it doesn't provide liquidity, right?
Right.
So that was just my.
I,
I mean,
I
it really does provide under many times a good liquidity. But what we're seeing now is
Right,
that you can't always count on it, because
right,
quarter after quarter, you could have redeemed completely out of Cliffwater House and it would have been fine. You would have had full liquidity.
right,
But I think what your question brings up for me is the thought of like, if I chose that was my one fund that I had as in my world, when I say 90-day money, that means I have liquidity within 90 days.
90 days, right,
So if I had all of my 90-day liquidity money in one spot, and it's something that can be gated, that's something I need to think about. And then the
right,
same kind of thing. It's like if I have two, if they're similar, am I going to be in trouble that way? Or do I want to make
right,
sure that they're different enough that it's
right.
not going to be a problem?
but
And I
but
like the comment about the cash. I mean, because you could put something in a high yield savings account at 3 to 4% and be okay with that for a certain amount of money. I mean, I think that's
I do think
also.
that I do think the diversification, both from a terminology and conceptual standpoint, it's there's reasons to diversify that some of them are, I think, correct and some are incorrect. Like diversifying to lower risk is usually diversifying across asset classes. But I think when you find a GP that you've invested in a specific asset class for the past 20 years, and you know that's a good GP who can perform, and you trust, and you're in that asset class, you might want to diversify out of that asset class. But I don't see maybe, and you guys can correct me if I'm wrong. I don't see a lot of logic in diversifying into another GP, which does the exact same strategy just for sake of diversifying GPs.
Agreed.
And you guys
I
might
feel the
disagree
same
with
way.
me. What do you think, Leila?
I disagree
All right, so let's talk about it.
strongly. Counterparty risk. You cannot you cannot in the private market space, fraud is something you cannot diversify enough out of. There's a high prevalence of fraud. When you take, private markets, especially the lower end of the private markets, and compare it to public markets, fraud is a lot more rampant. It's by a factor of many X's, right? Many tens. This is something, the counterparty risk is what you're diversifying from. Let's say you want, industrial, right, exposure, and you find a GP who's been doing industrial deals for 20 years and has a stellar track record. That GP can die tomorrow. That GP can turn bad. They can, it's plenty of instances, right? After 25 years, somebody just goes off the rails and starts embezzling funds. They can do, all of a sudden, they lose interest or they retire and their son comes in. There's another example anecdote for you.
Well,
And
then it's a
their
different GP.
child comes in.
But then it's a different GP in my mind.
Yeah, well, you still you
Kinda,
can,
because the son has probably been involved for the last 10 years. It's just that now they're in charge versus
and he
not.
goes
So
bad and he does
it
stuff that the dad wouldn't have done. There's all sorts of things that this is why you want to have like 4 or 5 industrial GPs who have 25-year-old record. Whatever the track
Yeah.
record, your personal, right?
yeah, I haven't. Latan, I'm more in your camp. I try to pick the best and then I concentrate with them. But at the same time, I don't know. I guess I haven't come up. I know guys that have specific caps on like with a particular sponsor in all of their funds, whatever, even if they have multiple strategies, they won't go above a certain level. Layla, do you have something like that? And if so, what is it? Because I keep track of it a little bit, but I don't really have any hard rules. Um, that way it's more of I try to pick the best and just keep going with it.
So I'm gonna mine's 2.5%.
Oh, wow. So
Most
you're very diversified.
well, it's a small bucket though, right? So
Wait, is it
it's
Okay.
2.5% of
meaning
100% of privates or 2.5% of your
over
overall?
100% of my net worth.
Oh,
Yeah.
so it's
Right.
not
Okay.
only the
Over the
privates because
overall.
you said only
Yeah.
like 10% of your net worth is in privates.
10%. So in the actually, this is probably, and I've never come close to 2.5% with anybody, but it's the privates are 10% of the privates bucket of the. I have all sorts of buckets, but yeah. So, anyways,
Yeah,
I
and I'm
would.
different. Like
So the
my
bucket
private
would
bucket
need to
is
grow.
100%.
Yeah, my bucket of privates is not like maxed out. It can grow up to maybe 20%, in which case 2%, I could probably live with 10.
I, I don't know. Like Mike and I know friends of ours who like Hans is one of them. There's no doubt he's like fraud risk zero with him. You can always argue, yeah, friends also can. There's a situation that happens as well, but I don't feel like I can be too allocated into someone like that where the problem is always just getting into a deal because they're usually oversubscribed. But I mean, again, there's no right or wrong, right? There's just an approach that each of us have. Any other questions from anyone around this topic, or Mike, you want to take something?
Well, what I wanted to circle back to, if you don't mind, because the private credit, there's a lot of people involved in it. There's a lot of money that we have in it. I'd love to hear your take on the private credit that's to businesses like what we're talking about with Cliffwater House, the BBC, the more public thing is now a good time to be investing. Because I know guys that are like 20% discount. This is great, and they're really loading up. And then also the what I still call it private credit. I don't know if you call it differently, but where it's real estate backed, where it's multifamily real estate lending specifically, or single family, fix and flip, that kind of thing. And sort of how do you see those right now? And what's your take on them?
So let's start with the latter, with the hard money funds, right? We'll call them single family funds, the funds that do real estate. You have a huge variety of flavors. You can go with guys who have a $15 million fund, who lend in their town to the borrowers they've worked with for 25 years, right? Who started lending their own money and now they run a small fund. I think there's a lot of fraud risk, especially with private credit funds, because this is especially important to watch cash flow statements with those kind of funds. But those are, if this is an honest person doing the right thing with a lot of experience, those are great. Do your due diligence and make sure that you're comfortable with it. Those are great because you have somebody who knows what they're doing in a particular space. And then from there, you can go up to there are funds that land across 27 different states and manage $500 million, and they're Regulation D funds, and they also may or may not know what they're doing. You have to figure out to what extent they know what they're doing, and you have to figure out to what extent you're comfortable with stress test it. Let's say, out of the book of loans, out of the book of their, 200 borrowers, what if 10% stop paying tomorrow and they have to foreclose, right? And it becomes credit funds are easy because it's a math problem. You can figure out how long what your recovery is. Those debt funds on real estate, if it's truly single family homes, it's 70% LTV. I mean, it's pretty hard to lose money, right? The fund manager will have to really screw it up to not be able to recover the principal of the loan. And then, the universe of private credit funds, the bigger ones, the Cliffwaters, the Blue Owls, those are funds that lend to private companies. And again, that universe almost should be looked at as a separate beast. There are very small funds that lend to private companies. There are very large funds. There are $30 billion funds that lend to private companies. It's harder in the sense that you almost have less transparency there because all you see is just the aggregate numbers. With a small fund manager who runs, a $100 million fund, oftentimes you will get the loan tape. You can go on Zillow. You can go into county records and check if there are liens, how much this property. You can just select a random selection of loans and do really good, really thorough due diligence on those, just to check the math. With those big ones, you don't have that luxury. It's a binary. It's kind of a funny thing because you have all this information, you have all these SEC filings, and at the end of the day, sometimes you can't tell anything about what's going on the portfolio level.
Yeah.
So
Um,
because I'm personally not invested in the business type loans, the private credit with that. That's been a little scary to me, even though I know a lot of people are doing it. But I am, invested in hard money, that type of thing, where they're loaning on specific assets, that kind of thing. So I was just curious to hear your take on that. So it sounds like your thought is as long as they know what they're doing, there's probably not a lot of risk right now, or maybe less risk than what we're seeing in the quote private credit, like the Blue Owls and the Cliffwaters.
I think there's an opportunity. I think the bigger question, and we can talk till the cows come home on this topic. Do we believe in the private credit universe? Do we believe the marks? Do we believe that the value of those loans is what we're being told? That's kind of a bigger issue there than in your example, Mike, with a hard money fund. Because with a hard money fund, you know what the asset is worth and you know what the LTV is. This is, that's pretty simple. With loans to private companies, we don't know what the asset is worth. We don't know what the LTV is. I mean, they're called senior secured, but sometimes they're secured with the assets of a software as a business, as a service company. And those are asset light companies, right? The asset is ARR.
Right.
So that's kind of
But
something
but
to
but
think
again,
about.
I have to say again, it's all about risk reward. At the end of the day, those funds where the underlying asset is not real estate, it's a private company, the reward that you should expect is much higher than what you get on a private credit that lends on real estate. And so again, it's not right or wrong. It's just like where you decide to allocate, Mike, versus people who have a higher risk appetite and want higher returns on debt. Um, and same goes for public markets, right? Same idea, because at the end, all these underlying assets, real estate, private companies, oil and gas, whatever the underlying asset is, you can access it through private equity, private debt, public equity, and public debt, and then each of them has a different risk profile and return profile. And so I think, and Hans did mention here, and a really important comment, obviously, we take it for granted, right? Because when we're going into vetting the GP, obviously, we also need to know how to vet a private deal because that helps us understand what questions to ask a GP about those specific deals. So you can't disconnect the two. So I agree with what Hans wrote here on the side. I just also to address what BD here mentioned, dude, 15% allocated in the public markets. You're like Mike. Mike hates the public markets as well. I think Mike is even less than you in the public markets. Um, and then yeah, just a bunch of stuff about leverage in the credit
Can I ask a
space.
question?
Sure.
Why do you guys hate the public markets?
I
What
don't hate
what
the
is it?
I don't hate the private markets. Mike hates the private
I,
market.
I wouldn't say I hate it. What it is I hope to someday be able to invest in public markets again. But they've just public markets have been overpriced for cash flows and equity I can get and things like that versus privates for so long that I'm currently at zero. So and I have been at zero for a while. But I hope and I think that I will. I think in the next decade there'll be a turn, and I think there'll probably be a time where that changes because kind of like what Hans said, you're at the whims of what people's emotions are. And so I think that we could hit a point in time where public markets would be equal to or even close. Like even if we got close to the same like sort of earnings, cost of earnings in public versus private, I would happily switch over because the liquidity would be great to have in my portfolio. But for me, that's been the thing is I have a lot of companies that I own, whether it's through stock or through other types of investments in LP type things in companies. I just don't do it in a public way. I do it in a private way.
Makes sense.
Yeah, it's a whole philosophical debate. And the bottom line is what we talked about, half hour ago with Mark. It's about what are you trying to achieve? What is your overall goal and your net worth from a number perspective? For many people, just allocating into the public's equity or debt, well, it doesn't matter, and creating a portfolio that achieves that goal might be enough. If you're trying to achieve a different outcome, then you need to allocate differently, right? So, um, and I think a lot of people stay away from the privates because of like they're not experienced enough. They're kind of afraid. They don't know what questions to ask, how to find good operators and stuff like that. And I think the more comfortable you are in that space, the more you'll probably allocate into it because there is alpha in the private markets, I believe at least. But Layla, you're still heavily in the publics, right? So that's where the questions come from.
Very. Mhm. But I know myself, know thyself, right? To me, liquidity trumps almost everything else. Just psychologically. To me, that's a fair
Oof,
price to pay.
liquidity,
Volatility.
liquidity is that's like another like hour discussion in my mind. Everything has liquidity at a price. Everything. And the question is if the stock market
I'll ping you. I'll send you some of the stuff that I would like to get liquid.
no, but I mean at a price. I'm just saying like if the stock market tanked by 30%, the fact that it's liquid means shit. And if your house, if you want to sell it at 30% below market, you can probably sell it within an hour. I'm just saying like liquidity is a whole ball game that has a whole conversation. I'm exaggerating, of course, right? I'm just saying, but liquidity, I think sometimes is in my mind is a bit overrated. Um, Listen, this is an awesome conversation, Leda. I had a super fun time talking, and thank you for sharing all this. Anything you want to sort of share, like last stuff before we sign off? If anyone has a last question they want to ask, yeah, and
I'll share
Hans,
something.
yeah, share, go
I'll
ahead.
say one thing. LPs, please demand more transparency from GPs. Let's make this playing field better for everybody involved. And transparency is my one gripe with private markets.
Yeah, cool, awesome. Mike, any last notes? All right.
No, I just appreciate you coming on. It's been great. Great to hear your wisdom.
Yeah. So,
Thank you for having me.
thank you so much, everyone who joined. I'm going to share this recording afterward. Also, Layla's contact information and her newsletter and all that. Feel free to reach out to us, to her. Have a great rest of your week and see you all next week. Thank you so much.
Thanks.